Our next speaker is Stuart Hooper. Stuart's the Managing Director of Transaction Services of PricewaterhouseCoopers. The PricewaterhouseCoopers Melbourne Deals team, as leader of that, the primary focus is in agribusiness, consumer products and retail sales. Stuart was raised in regional Victoria near Leongatha and has a pretty strong and passionate family connection with rural Australia and agriculture. I think he's still got a fair bit of skin in the game in terms of a dairy farm down there. Building off his rural background, Stuart has worked on a number of transactions in agribusiness at the processor and the farm gate level, and over 13 years' experience in PwC has worked on a range of transactions including both buy-side and sell-side due diligence projects, initial public offerings and takeover defences. Stuart recently completed 3 years in the PwC New York office, where he worked with global private equity clients on large complex buyouts. So to give us his perspective on the finance of agribusiness and where it's heading in Australia, please welcome Stuart Hooper.
Thanks, Mick. Look, as mentioned, the majority of my time is spent working with an array of corporate and private equity clients, looking at acquisitions and divestments, and I'm fortunate enough, given my background, particularly in recent years, has been spending a fair bit of time in the agri sector, but also extending through consumer goods and retail sort of is the focus. So to that end, and when sort of asked with this question around funding agribusiness, and particularly from that perspective, I sort of thought, well, through an M&A and transaction lens, it might just give a bit of a view. That said, I'll probably start off many similar kind of points to Angus, but some of the themes from a demand perspective, I just wanted to cover because I think it gives the right context to why we're seeing particularly a lot of foreign investors knocking on the door at the moment, and hopefully that will provide some context. So after that, just going to run through some of those foreign investors, different types, and what I think that they're looking for. Certainly is what they sort of say to me, at least. Some themes in the dairy sector specifically, and I think everyone understands the dairy sector is running pretty hot at the moment. There's plenty of activity out there. There's plenty of talked about transactions, potential consolidation, etc. Local debt markets, which are important. I know there's a number of the banks here today, and I spent a bit of time with the agri bankers from particularly the big four banks and Rabo, and I think it just wanted to give a bit of context of how we see that from an M&A perspective at the moment, and then just at the end I'll just cover off some sort of thoughts we had around maximising opportunities for growth. Actually, yesterday I had a session in Sydney with it was a global investment bank, and there was a chief economist at that particular bank. These presentations, I'm sure most of you have seen them, and they do the rounds, and there'll be lots of them. Lots of them will continue, and after sort of covering off on global trends, they sort of ducked down into Australia and spoke about the investment in mining, and how it's sort of 40% investment year on year in 11 and 12, 40%, and this curve coming off, and what would fill the void. They didn't say agri would fill the void, but agri was sort of the top of the list. So from their perspective, from an economist's perspective, they see agri as and it is obviously the Asia dining boom and the demand drivers which will lead to that. But it's interesting that it's one of the key themes within these presentations now, and so I think it will only sort of exacerbate the debate and drive a lot of discussion, similar to some of Angus's points. On the long-term demand drivers, and we kind of don't need to reiterate this, and I think it's fairly well publicised and published, but obviously the middle class boom in Asia is what ultimately is the most significant demand driver, and will really lead to significant investment coming into this country. You can talk about some rough numbers of sort of 500 million middle class in the Asia Pacific region through China, 9 growing to 3 billion in 2030. That's not population growth, but that's just growth in that middle class as urbanisation happens, and then diets change. And without sort of just reiterating Angus's points, there are just numerous historical precedents, and obviously the studies that Angus was involved with, drew on a number of those. But certainly our expectation is just that what we'd call premium foods, which is your basics, your meat and your dairy products, will have significant demand drivers. I think it's important though to sort of recognise that while the Asian dining boom will continue and will grow, there are still the markets which we're also lucky to service as a country, the likes of Japan, premium markets like that, which do help drive some premium pricing for particularly our dairy and meat exports. On the commodities side, obviously a huge part of Australian agriculture, but potentially in the future, maybe expecting more of a more complex array of sort of niche, higher value products to come through the agribusiness sector, targeted at these emerging middle classes and their particular palates. Still on a sort of the macro level, just wanted to quickly touch on, again, dairy. It's been a really interesting last couple of years. So China, there's been a significant increase in purchases of dairy products into China. I think 40% increase in sales of dairy products to China in 2013 to over 2.1 million tonnes, which is nearly double the total volume of 2011. And then it's interesting as well, because with that concentration at the expense of other regions, there is price volatility that comes into the market. And I think, if you look at the current whole milk powder pricing, sort of dropping 20% in the last sort of 4 or 5 months, it is just a China story. But we probably haven't necessarily had that China story in the past, just because of how quickly it is growing and those demand implications and supply implications. Just one final point, sort of just more broad macro themes. Obviously, the opportunities for agribusiness will differ depending on the types of different countries and the different rates of growth. India has been a country that's been flagged as sort of sitting behind China, almost to continue with an urbanisation theme. Those predictions from 3 years ago probably haven't come through as much. But that said, there'll be certain things, be it almonds, lamb, and potentially business services. These types of products Australia does well, and a country like India will continue to be important. The food security side of things, it is a genuine driver, and in the conversations I have with particularly Asian foreign investors, food security is something which is sort of the top of the list, and we start off talking about extremely large volumes of potential products, and then we sort of whittle our way down to actually what the Australian production would be. But it is just a never-ending theme and continues to grow. So I haven't put a whole lot of graphs in this pack, but just wanted to make a point on this one that while we sort of look at the opportunity which is coming, which is this Asian boom, I suppose we do have to think about from an agribusiness perspective where the production will come from. So there's going to be significant investment and equity required and capital required to drive that. And ideally, there's various estimates of what that number will be. It is significant, and Angus has provided some numbers, but ultimately, it's going to require some foreign capital, but hopefully supplementing some domestic investment, and then in combination, driving employment, innovation, productivity, and ultimately global competitiveness within Australia. The most common, if you ask any particularly foreign investor, what are the things which attract you to Australia and perhaps why it is such an attractive environment? And I deal with a lot of particularly private equity firms out of Hong Kong, and they spend a lot of their time looking at opportunities across Asia, and they're always more than happy to jump on a plane to Sydney, to Australia, because of just some of these really simple economic factors. The stability we have in interest rates and exchange rates and inflation is something which you just don't get. It just hasn't had particularly over the last 5 years through the GFC, we just haven't seen that in many other countries around the world. And then the micro sort of economic factors, including the skilled labour and the education that's gone with that, the access to raw materials and production inputs, the infrastructure at an acceptable cost, and obviously work to be done on the infrastructure side. Environmental factors and quality of living considerations are all significant. And the quality of living one is interesting as well, depending on who you're dealing with. Often, the thought of spending significant amounts of time in Australia is very attractive, and it seems a kind of funny thing to say, but it is actually, I'm sure, a consideration when people are putting other people's money to work. Socioeconomic factors, regional other export markets, openness to trade and investment, and then on the political side, obviously, relative stability compared to elsewhere in the world and absence of corruption, etc., and enforcement of contracts on the legal side. So with all of that, it's an investment landscape which is very favourable. And then I think when you then delve down into some of the agri-specific risks and volatility of Australian agriculture, they are significant, and that's where the conversation starts to get quite interesting. And there's plenty of bad investment stories out there, and I'm sure everyone has them, which would highlight that point. So with respect to foreign investors, I just wanted to touch on just a couple of themes here. So the PwC Australia team, we basically field requests from the whole network around the world. So these will be clients of the firm. These will be M&A mandates that have come through. And with that, we sort of try to have an understanding as best we can of the opportunities that are currently in the market. But a lot of those discussions, just to give you some idea of my day, a lot of those discussions are a few calls, and then it all sort of comes to a bit of, it would all cease. Particularly on the agribusiness side, I mean, the returns, there's this heady expectation. I think it is this conversion of this demand into ultimately cash in either at the agribusiness level or the farm gate level. But if you look into the history, and obviously David this morning sort of spoke about some of the corporate farming numbers, there's not those great examples there. So it's more of an education process more than anything. But certainly the level of interest, the number of inquiries over the last 12 to 18 months has been significant and growing. By location, or by country at least, China's probably the country that stands out, just with a significant number of conglomerates and SOE related businesses that are ultimately looking to focus on a particular staple, a particular sector within agribusiness. So on the corporate sort of strategic side, and I'm talking from a foreign investor perspective, just the education process is I suppose, the most significant thing. The variability in returns, the risks, just simple things around weather. It takes time to get everybody on the same page. At the farm gate, there's a genuine disconnect between sort of the cash flow based valuations. So everybody will still run a model, and it will spit out a neat little number. But ultimately, when you compare that sort of underlying land prices, and you get into some fairly circular conversations around what a particular farm gate asset might be worth. There's a reluctance generally, on the farm gate side at least, to assign much value to the capital appreciation going into the future. And I suppose that is partly because a lot of these, from a food security perspective at least, these assets would be held. The investment thesis wouldn't be about necessarily capital growth. On the private equity side, spoken to a number of sort of the larger US private equity funds. They're interested in Australia and interested in agri and food, just really for portfolio balance. I think when you talk to your LPs, it's a great story if you're plugged into global population growth, food security. So they're all good buzzwords and hot topics, which obviously LPs would appreciate. But they have actually raised various funds, natural resource type funds, which include and are open to agriculture investments. The returns thresholds are tempered compared to what they'd expect out of their normal growth funds, and also slightly longer investment horizons than what we'd normally see. On the pension funds, some pension funds that we've spoken to have adopted minimum investment quotas for agri, and while they're not significant, it is an interesting move, and it suggests just ultimately a longer term view of pushing to agri and trying to capture those demand drivers. Interestingly, on the pension fund side, then obviously normally reasonably passive investors, but that line seems to be somewhat blurred. Certainly some of the ones that I've dealt with are willing to take on some operational and execution risk. Less interaction myself, at least, with domestic super funds. but I'm obviously aware of a few bespoke investments they've made into various funds. One consistent theme across all of those different investors would be they're looking for scale. And so single transactions, they're looking to write cheques of 50 to 100 million. So there's only so many opportunities for them as it stands right now. So similar to other developed countries, at the farm gate at least, obviously highly fragmented. There is some willingness to do a roll-up, but it's not rolling up from a single dairy unit. It's, they need a base to start with to get that through their investment committees. So I thought I'd just quickly touch on a couple of things in the dairy sector. I've had some involvement recently. I was involved with the Warrnambool cheese and butter takeover, so on the Warrnambool side, from a due diligence capacity. And I think that was really the spark, if you like, for what has been a lot of focus on the sector. Obviously, ultimately, the premium that Saputo paid drew a lot of attention, and whenever you have an agri discussion now, it tends to be something which is one of the first topics. But I think it just has really focused the light in on the dairy sector. In addition to sort of the record milk prices, and obviously where we see powder going, or at least where powder was 4 or 5 months ago. So some of the other themes in dairy which we spend some time talking with different processors about are just really how to maintain and grow share. If you look at overall production, obviously relatively flat. And there's a number of farm gate investment models that different processors, agribusinesses are looking at, and they're actually underway. So one that jumps or stands out at least is Murray Goulburn's running a couple of different programs. There's a next generation program which I'll get to, and then there's a partnership program which is a slightly more significant investment. Next generation is it's designed really to encourage suppliers to invest in land, cows and permanent water, and then ultimately there's growth incentives which will be paid through their milk check to contribute towards that investment. So really it's an interesting or a good way, I suppose, to drive some increased production and ultimately within the MG supplier base. And there are similar types of programs being run by others of the significant or the major processors rather. The partnership program, so working with a farm management team, Murray Goulburn basically enters into arrangements to lease properties that are purchased by these by our external investors, and so that gives the ultimate financial investor some surety of return. From a Murray Goulburn perspective, they're obviously able to then pass that farm on to a supplier who will lease it on the same terms. But it's another interesting model, I think, or an interesting way to ultimately secure some supply, but also start to get suppliers onto larger farms. So I mentioned the Warrnambool cheese and butter takeover. It's sort of the first of a number of sector acquisitions or transactions rather. UDP was one, Parmalat, acquisition of Harvey Fresh, and then just last week R&R, which is a French-based company, or French-owned at least, acquired Peter's Ice Cream for a reasonably full price. So there's likely further activity in our view, with limited growth in overall production in the near term, and there's plenty of, obviously from a manufacturing perspective, plenty of capacity in the network. You'd see consolidation to be a natural outcome, and ultimately there are other food companies which we talk to who are looking to actually secure some supply as well, and so again it becomes a function of how that looks from a processor perspective. So I spent a little bit of time with our debt advisory team, just sort of talking about the local debt markets, and this is more from a transaction perspective, so the ability to actually leverage transactions and fund transactions. And look, the overall point is that the debt markets are very strong at the moment. We're seeing good appetite from the major banks and Rabo, and lots of competition between them, which is driving some reasonably aggressive pricing, which is good. On the question of leverage, and I think often leverage gets a bit of a bad name. We talk about over leverage, and ultimately gets blamed for a lot of failure in agribusiness, and ultimately, I suppose we often can overlook some of the operational inadequacies, and ultimately the debt ultimately underpins the majority of the success stories as well. So there just needs to be some balance, and I think, right now we're in a phase, post sort of a de-gearing phase of corporate Australia, post the GFC. So the last sort of 3-4 years, corporate Australia is de-geared. So I think that's also one of the major drivers of the bank's willingness to lend at the moment, and looking for, aggressively looking for opportunities. We spent a bit of time with the different agri teams within the banks, and certainly the resources and the investment that the banks are putting into the agri sector at the moment suggests that it's a key area of focus, and certainly considered a growth sector within the banks. We're also seeing some Chinese and Japanese banks coming to Australia, not from an agnostic perspective, but actually focusing on agri in Australia. And ultimately a good appetite for M&A activity. So the Ingham's transaction last year was about 750 million of debt raised. It was oversubscribed, aggressively priced. There's about 13 banks involved. And so with a leveraged bite like that, it's a good sign. And just the final point from a banking perspective is, just wanted to sort of mention that, I think where you've got sort of this cycle-driven volatility in agri, which we all understand, and the cash flows, you clearly need the bankers to have a strong understanding of your business, as opposed to some of the volatility as opposed to the sort of set and forget type debt, the bond market, etc., etc. So just to finish, I just wanted to touch on a couple of areas or opportunities to growth. And look, I suppose while there is all of these demand drivers, and while Asia sits up there, I suppose knowing your market and ultimately playing to your strengths is very important. I believe brand Australia has significant currency, certainly different in certain sectors. We've got a great, clean and green country, great platform really to build on. And I suppose the value of this platform should only really increase over time, you think, as sort of global population grows. From a pricing perspective, what products and sectors will attract premium pricing is important. If you look at our overall production, clearly we need to sort of be maximising through the value add. And I think, on that basis, we won't be the lowest cost producer, so to the extent that we can have these premium products and hit the premium markets, it's the obvious opportunity. Foreign investors, clearly based on, at least on the phone calls at least, there's plenty of interest, and really it's probably as much of a question of how the domestic players will respond, but you'd think that competition for assets should increase, but ultimately there's been plenty of fingers burnt in the past, so I suppose there's got to be some balance. Thank you very much.